Gross domestic product, or GDP, this is a figure that holds the key to understanding a country's economic policy. It's not just a number, it's the ultimate gauge of how productive and powerful a country's economy truly is. Whether you're an investor hunting for opportunities, a business leader strategizing for growth, or even a policymaker shaping the future, knowing and understanding the GDP figure is important. The GDP is usually your go-to figure to making an informed decision. In this video, we'll discuss gross domestic product as one of the concepts in economics. We'll also cover the various types of GDP, as well as how GDP is calculated. We'll then discuss some of the limitations of GDP, and then conclude by discussing the importance and significance of GDP as an indicator of a nation's economic health. So, subscribe now to Kano Academy, and let's explore this fundamental concept of gross domestic product as part of the subject of economics. Let's first explain what GDP is. GDP stands for gross domestic product, which represents the total monetary value, or market value of finished goods and services produced within a country, during a period, typically 1 year, or a quarter. In essence, GDP is a measurement of domestic production, and can be used to measure a country's economic health. At its core, GDP measures economic activity. This includes everything from the production of goods such as cars and electronics, to services such as healthcare and education. Economists often use GDP to gauge the size and performance of an economy, making it a crucial tool for policymakers, investors, as well as researchers. GDP can be approached and reported in several ways, each of which provides slightly different information. Let's now take a look at the following two main types of GDP, being nominal GDP, as well as real GDP. Nominal GDP, or current GDP, is an assessment of economic production in an economy that includes current prices in its calculation. In other words, it doesn't take out inflation, or the pace of rising prices, which can inflate the growth figure. All goods and services counted as part of nominal GDP are valued at the prices that those goods and services are actually sold for in that year. Nominal GDP is evaluated in either the local currency rate, or it is converted to US dollars at market exchange rates, making it crucial for comparing economies globally. Real GDP, on the other hand, provides a clearer picture of an economy's actual productivity by adjusting for changes in price levels over time. By accounting for inflation or deflation, real GDP eliminates the distortions caused by fluctuating prices, making it possible to compare economic output across different periods more accurately. This means that, looking just at nominal GDP, it can be difficult to tell whether the figure has risen because of a real expansion in production, or simply because prices rose. So, in order to arrive at a real GDP, economists would adjust the nominal GDP for inflation. This way, it is possible to compare a country's GDP from one year to another, and see if there is any real growth. The main difference between nominal GDP and real GDP is that nominal GDP measures a country's economic output using current market prices, while real GDP adjusts for inflation or deflation, providing a more accurate representation of a country's economic growth. Nominal GDP is also usually used when comparing different quarters of output within the same year. But when comparing the GDP of 2 or more years, real GDP is used. This is because, in effect, the removal of the influence of inflation allows the comparison of the different years to focus solely on volume. There are 3 primary approaches when calculating GDP, and these are the expenditure approach, the production approach, as well as the income approach. The expenditure approach. This is the most common method, which adds up all spending in the economy. It includes household consumption, government spending, investments, and net exports, which is the difference between exports and imports. The production approach. This method sums up the value added at each stage of production. The income approach. This calculates GDP by adding up all incomes earned in the economy, including wages, profits, and taxes. Let us dissect these approaches even further by looking at the formulas used for each approach, starting with the formula for the expenditure approach. As indicated, this is the most common GDP formula used, which is calculated as GDP equals consumption plus investment plus government spending plus net exports, represented by exports minus imports. The formula can be depicted as follows. The components of this formula are depicted by these symbols. C is household consumption expenditure. This refers to the total spending by households on goods and services, such as food, clothing, healthcare, and entertainment. This is typically the largest component of GDP. I is gross private domestic investment. This includes spending on goods that will be used for future production, such as machinery, equipment, and buildings. It also encompasses residential construction and changes in business inventories. G is government spending on goods and services. This represents the total government expenditure on goods and services, including salaries for government employees, infrastructure projects, and public services like education and defense. X, on the other hand, represent exports. These are goods and services produced domestically and sold to foreign countries, contributing positively to GDP. While M represent imports. These are goods and services purchased from foreign countries. Imports are subtracted because they represent spending not contributing to domestic production. X minus M, or NX. This indicates the balance between a country's exports and imports. If exports exceed imports, the balance adds to GDP. But if imports exceed exports, it subtracts from GDP. The second approach we'll cover in this video, when determining GDP, is the production approach, otherwise referred to as the output approach, or even known as the value-added approach. The production approach is essentially the reverse of the expenditure approach. Instead of measuring the input costs that contribute to economic activity, the production approach estimates the total value of economic output and deducts the cost of intermediate goods that are consumed in the process, like those of materials and services. The production approach measures a country's total economic output by summing the value added at each stage of production across all sectors. It focuses on the value added by each producer, firm, or industry within the economy. The formula for GDP using the production approach is GDP equals value of output minus value of intermediate consumption. In this formula, value of output is the total value of goods and services produced by all industries within a country. This represents the total value of goods and services produced within a country during a specific period. It includes both final products and intermediate goods used in production. This formula also takes into account the value of intermediate consumption, which is value of goods and services used in the production process, including raw materials. For example, flour used in baking bread would be part of intermediate consumption. When determining GDP using the production approach, the answer would be the difference between the value of output and the value of intermediate consumption. This difference, also referred to as value added, ensures that only the economic contribution at each stage of production is counted, thus avoiding double counting intermediate inputs. This method highlights the production aspect of GDP by focusing on the contributions of various industries and sectors. GDP can also be calculated using the income approach, which sums up all the income earned during the production of goods and services. The formula for income approach can be represented as follows: compensation of employees, plus gross profit, plus gross rental and royalty income, plus taxes on production and imports, minus subsidies. The components of this formula can be briefly explained as follows. Compensation of employees. This represents the total earnings by workers for their contributions to production. It includes wages, salaries, and benefits like health insurance or pensions. Gross profit, which is often also termed operating surplus, this is the profit businesses make after covering their production costs such as materials and labor, but before paying interest, taxes, and other deductions. It reflects the returns to entrepreneurship and capital investment. Gross rental and royalty income, this component includes income earned from renting out property, equipment, or other assets, as well as royalties received from intellectual property, patents, or natural resource extractions. It accounts for earnings from the use of assets, rather than direct labor. Taxes on production and imports, these are taxes imposed on producers and the importation of goods, such as excise duties, tariffs, and value-added taxes. These add to the cost structure of production and contribute to government revenue, thereby being part of the overall economic income. Subsidies, which are subtracted, are financial aids provided by the government to support specific industries or consumers. Since they represent assistance rather than income generated through production, they are subtracted from the sum of all other incomes, in order to avoid overestimating GDP. Essentially, the income approach ensures that every element of income, from worker compensation to business profits, is accounted for when measuring a nation's economic output. This approach also provides a complementary perspective to other methods of GDP calculation, emphasizing the earnings side of production and distribution. Even though the GDP is a valuable metric, it does, however, have its own shortcomings. Let's discuss some of them. Firstly, GDP is determined by aggregating the total economic output, without revealing how income is distributed among a population. This means that a country might have a high GDP, while a significant portion of its citizens struggle with low incomes. This essentially indicates that GDP growth does not necessarily equate to improved living standards for everyone. Another limitation of GDP is that many valuable activities are left out of GDP calculations. Household labor, volunteer work, and bartering transactions, even though they contribute to societal welfare, are not reflected in the GDP determination. This exclusion means that the true economic output, especially in areas with significant informal or domestic work, is severely underestimated. GDP also does not account for the costs associated with environmental damage. Economic activities that lead to pollution, resource depletion, or other forms of environmental degradation may boost GDP in the short term, yet they can impose costs on society that are not deducted from the measure. This makes GDP a potentially misleading indicator of sustainable economic growth. Another shortcoming is that GDP is strictly focused on economic production and monetary transactions. It does not consider factors such as leisure time, health, education, or overall life satisfaction. A rising GDP can occur alongside declining quality of life. These limitations suggest that while GDP is useful for gauging overall economic production, it does not provide a complete picture of economic welfare, sustainability, or the social fabric of a society. Because of these shortcomings, economists and policymakers often consider complementary indicators to provide a more rounded view of economic and social progress. These complementary indicators include measures of income distribution, the Human Development Index, or HDI, or genuine progress indicators. So, why does GDP matter? GDP is often referred to as the world's most powerful statistical indicator of economic progress. It helps governments, businesses, and other organizations make informed decisions about fiscal policies, investments, and resource allocations. So, whether you are an investor or business, a politician or government official, or even a citizen, GDP will have an impact on your current decisions and your future plans. For an organization or business looking to expand into new markets, GDP can be used to evaluate which markets would prove healthiest, while an investor interested in emerging markets might use GDP to understand which countries are growing at the fastest rates, and therefore, might provide the greatest return on investment. On the other hand, a politician, policymaker, or government official, might use GDP to understand how policies have impacted the economy. GDP also provides insights into sectors that may require government support, or even legislative or policy intervention. GDP provides data on the growth or decline of the economy. This in turn affects citizens, and also influences job availability, wages and salary increases, and the overall standard of living. Citizens may therefore use the GDP information to make informed decisions about their spending, savings, and future investment, based on the prevailing economic conditions. It is important to mention that GDP remains a cornerstone of economic analysis, providing a snapshot of a nation's economic health and guiding policy decisions. If the number is growing, then the economy has become more productive. However, if the number is shrinking, then the economy has become less productive. This comparison can be especially insightful when conducted over an extended period, as it allows for long-term trends to emerge. As economies evolve, there is a growing need to complement GDP with other indicators, in order to capture a more holistic view of progress and well-being. Even though GDP is just but one financial metric you should seek to understand, it is however undoubtedly an important one. We've come to the end of this video. Remember that you can always re-watch the video if you need more understanding on the topic. We also hope we were able to provide more clarity on the topic. If we have, please leave us a comment below this video. We'd love to hear from you and what you have learned from this video. You can also like this video to show your appreciation, and please spread the word by sharing it on your social media or via WhatsApp. Until we meet again, happy learning from Kano Academy.
Stay creative, stay curious, and stay connected.